Yes. What they are saying is, see the thing. It is related to what? It is related to tangible assets. Is that investment property? Fine. Investment property is which it is related to which standard?
40.
40. 40. Good. Is it right? It is related to investment property. Fine. Property A. Okay. There are two different properties. Property and property B. Okay. Next. An office building has been used for speculate. Used to by speculate. Speculate is the company name. Okay. For administrative purposes. Means they are using for office. Is it right? It is for plant, property plant. When they use they say that it is for administration purposes. Is it right? They say is it? They say it is for administration purposes. It is nothing but it is for IS 16. Is it right? On 1st April, it has a carrying amount of how much? 1114 2002. Okay, it is carrying amount. It is not carrying amount is how much? Carrying amount is it is 2 million. Okay, 2 million. Fine. It is how much? 2 million. And a remaining life is how much? The remaining life. See, these are very important, is it right? Remaining life is how much? Remaining life is how many years? 20 years. On 1st October, is that 1st October 1/10/2002, is that the property was let out to the third party, is it that they have given it for rent, is it right? On third and reclassified as an investment property, is it right? And reclassified as a means it once it is they are using it. See here they are using it here they are using it for the office purposes. It is IS 16. Here they are using for what? They are using for investment purpose. Is that they are using for investment purpose? It is the standard will change. Is it right? IS 40. Is it right? Now they have given it for the property has been fair value. Is it right? How much is the fair value? Fair value is how much? It is 2.3 million. On when it is on the same year, same we don't want to change it. 1/10/2002 and 31st March after 6 months. Is it right? After 31st March 2003. Is it right? The fair value is how much? The 30 fair value and it is not fair value. Therefore, 31st March 2003, the value is how much? 2.34 million. Is it right? Dates are very important. Is it right? That's I'm very much here. How much is there? Here we have 6 months. Is it right? We have 6 months, and again here we are having how much? We are having in between 6 months. Fine. Fine. Okay. That is. This is related to what? This is related to property A. Is it right? This is related to property A. Is it right? This is related to property. First, we'll do that for property A. Okay. What they are asking is what is the correct treatment when property is reclassified as an investment in the property. Is it right? What is the correct treatment? We have to make sure that how much is they have revaluation. Is that they have did revaluation how much? They did revaluation for 2.3 million. Is it right? They did revaluation for 2.3 million. Is it right? Now they have reclassified. They read the how much. First, what you have to do? Any idea? Any idea? First, what you have to do? Step 1. Is it right? Step 1. First calculate, is it right? I will divide this into two grades. Okay. This is step. First you have to calculate depreciation. Is it? First you have to calculate depreciation till 1st October. Okay. 2002. As a IAS 16. Okay. Is right? 1114/2002. What is the cost? Cost is 2 million. Okay. Cost is how much? 2 million. Less depreciation. How many months? 6 months. Is it right? Less depreciation 6 months. What happens? $2 million times $2 million times for 6 months you have to, is it right? 6 by 12 into 1 into 1 by 20. How much you will get?
$50.
How much?
50.
50?
Yes.
1 minute. 2 into 6 divided by 12 equal to divided by 20. It comes to how much? It comes to
50,000.
50,000. 50,000 means 0.05. Is it right? 0.05. How much you will get? 1.95 million. Okay. Is it right? This is the carrying amount. Okay. This is the carrying amount as on 1/10/2002. Is it? This is we have done as per IAS 16. Okay. This is we have done as per IAS 16. Now, is it right? This is we have done as per IAS. Now step 2. Okay. Next step 2. I will put like this. Is a step 2. Is it? This is step 1. This is step 2. Fine. Next, when you do the thing, step 2. What is the revalue, fair value? They have said fair value. Is it right? How much is there? Fair value is how much? Fair value is 2.3 million. Is it right? 2.3 million. Fine. Next, what is the carrying amount? Carrying amount is nothing but, because you have to differentiate. Is it right? Carrying amount as on 1/10/2002. Is it right? How much is there? 1.95 million. What is the difference? Difference is 0.350 or 350,000. This is the gain on revaluation. Is it okay?
Yes, it's okay.
Yes. Is it right? How much is the gain? What they have said, take 350,000 gain to our OCI, take 355 gain to statement of, we will never take to the statement of profit and loss account. Okay? We will never take, this will never happen anytime. There is no 400. Is it right? There is no 400 for this. Is it right? The answer is yes. Is it okay? Slowly you have to do. Okay? It takes time. Fine. Which, can I go to the next one? What it says, which of the following models can speculate? Speculate is the company name, don't get confused, okay? Used to account for investment properties as a individual financial statement. Is it right? When we are talking which of the following models can speculate to accept to account for investment properties. Whenever we are talking about investment properties, is it right? Investor, what is the rule? Just that's why yesterday I sent you a message. Is it that you have to revise it? When you are talking about investment properties, is it right? Investment properties, what we have done in the previous case, we will take into consideration what? We will take into consideration the cost as per the cost, or we will take into consideration as per the revaluation model. Okay, we will revalue it. That's what we are saying. We are going to revalue it and we will consider on the revaluation. We will never take into consideration the fair value as such. Is it right? Means investment property. When what happens when it is going to be disposed it of? Okay, the condition says that when it is disposed it of, in that situation only we have to evaluate it at that particular time. That is the basic rule what it states in the IAS 40 as such. Okay, answer is what? Answer is this 1 and 3. Revaluation is not, fair value is not there. Here also fair value is not there. All three are not there. Is it right? Next, what is the total gain for investment properties to be included in the speculate individual statement of profit and loss? Is it right? Individual statement of profit and loss for the year ended 31st March. Later you answer now. What is that? How much is happening there? Is it right? Now see the things. What is how much is they have two properties. Is it right? Property A and property B. Property A is how much? What is the value of property A? 31st. Is it right? I will put like this. We don't need this. Fine, we don't need. Now this is 233. Is it right? Next, first we have to take into property A. Is it right? Property A. Is it when we are doing this? We are doing it on 31st March. Is that we are doing it on 31st March? Wherever there is a doubt, just stop me. Okay, 31st March 2003. What is the is that what they are saying? Individual statement, investment properties. Is that they are very, very clear. Is that property B is what? Another office building let on 12th month lease to the subsidiary of Speculate as at 1 April 2002. It has fair value of 1.5, which has risen to 1.65. Is it right? Fine. Means they are asking us what is the individual, what is the gain they are asking. Is it right? Definitely the property value has been increased. Is that property A? Is that 31st property A is how much? 31st. Where is my marker? Yes, property 31st March. Is it right? 31st March 2003. How much is that? 2.340. Is that 2.34? Is that 2.3? Okay, 2.34. Now they have already we have done for till October 1st. Is it right? Value as on. Is it right? Less. less value as on, is it right? Value as on 1st of October 2002, is it right? How much was the revaluation amount? 2.3 million, is it right? 2.3 million. Difference is how much? Difference is 0.040 million. Fine. This is what the revaluation for the property A. Is it right? For property B, is it for property B? What is the value? 31st March 2003. Is it for property B? How much is the 31st March 2003? Yeah, 1.65. Is it right? 1.65 million less. Is it right? As on 1st of April 2002. Is it right? Nothing is there. As on 1st of April means, see the difference, you know this, okay? Keep it in mind. The difference is very clear. When you are converting from the property, plant and equipment to investment property, on the investment property we should not calculate depreciation. Understand my point? This is the condition of IS 40 with respect to the presentation. Is it right? That is the reason we are not calculating depreciation here. Is that 1.50 million? Is it right? How much you will get? You will get 0.15 million. Total is how much? Total is 0.040 plus 0.15. It comes to how much? 0.190 million, okay, or $190,000. Okay, are you clear about this? Is it 190,000 or 0.190 million? Is it okay? Where is our big boss? He is not seen. Is it right? Is it okay?
Yes, it's okay.
Fine. Now, what they say in the individual and consolidated financial statements are speculate how would property will be accounted for. Is it right? If it is an individual, if you are talking about the individually, definitely individually is of property B. Is it right? We are talking about what? We are talking in terms of property B. Okay, we are talking in terms of property. Where is it? We are talking in terms of fine. Is that we are talking in terms of property B. Property B is the investment. IAS 40. I will not write that. I will write as a 40. If you take individual, is it right? If you take individual accounts, is it right? We are talking the if it is identified as a investment property. Is if it is consolidated. Consolidated means we are talking in terms of property A and property B. Is it right? If you're taking into consideration the factor related to forget about the individual. Okay, we are talking in terms of the company perspective. If we take company's perspective, we will take it as a property, plant and equipment. I will write here from individual point of view. Is it right? From individual point of view, property B treated as an investment. Is it right? From individual point of view, is it property B, is it right? Property B treated as a investment property. Is it? But when we are talking about the consolidation, we have not done, we'll do this consolidation. Is that if you are making consolidation, is it? Consolidation means of property A and property B. Is it? Property and in the financial statements. Is it? In the financial statements. Is it? Then it has to be treated as IAS 60. The reason is, see, you are halfway through, you have let it for the for your own purpose, and halfway you have let it for the purpose of the investments. Is that? But the moment you consolidate it, the IAS 16 will take the priority compared to IAS 40, because you are consolidating the individual income, you are consolidating the business income. Is it right? You are consolidating individual income, and separately at a later stage we are going to segregate it. Is that? Again we are going to segregate it. What is the individual income and what is the business income? Okay, that is one of the reasons why we are going to identify it as a separately. Anytime the rule is very specific. Anytime individually, if it is there, it has to be identified as a investment property, and as a consolidation. Consolidation is nothing but I will just give you have the maybe you have the idea. Consolidation means we are putting the things, we are merging the businesses of two different companies within the group. Okay, within the group. Fine. Next, what is the? Can I go to the next one? What is the carrying amount of property A? Is it right? Carrying amount of the property A as per 31st March. Use the cost model for investment. We are not talking about the fair value model. Is it right? We are not talking about the fair value model. What is the, when you are talking about the cost model of investment properties? What is the cost model of investment properties? We have to make a depreciation. Is it right? Revaluation model will not take. We will take the, if we have only two models. Is it? One is cost model and one is revaluation. In the cost model, we have to take the depreciation. Is it right? For investment properties. How much is there? What is the carrying amount is there? What is the carrying amount is how much? The carrying amount, is it right? The carrying amount as per 1/4/2002. It is how much? 2 million. Is it right? It is going to be the, what is the remaining life? What is the remaining life? Remaining life is for how many years? 20 years. Is it? How much? See, what is the most important thing? IAS 16, 6 months. Is it right? IAS 16 for 6 months. IAS 40 for how many months? 6 months. Is it right? When we are talking in terms of things, is it right? While we are talking in terms of things, we have to take what they have made the revaluation. Is it right? If that is the case, it will not make any difference on the fair value. Fair value will become irrelevant. Okay, fair value will become irrelevant. We have to take the cost model. Is it cost model as well as the revaluation? Now, how much is the depreciation we are going to charge? Is it right? We are going to charge for one year. Is it right? Depreciation as per cost model. Is it right? Depreciation as per it's the same rules. Cost divided by life. We don't have any scrap. Is it right? How much is there? 20 million divided by 20 years. It comes to how much? 1 million. Is it right? It comes to how much? It comes to how much? 1 million. $20 million or how much? How much? 1 million. It is sorry. It is 2 million. Divided by 20. Is it right? 2 divided by 20. How much you'll get? 2 divided by 20. How much you'll get? It comes to
0.1.
0.1 million or 100,000. Is it? Now, what is the carrying amount? Carrying amount as on 31st March 2003. Is it right? 2003. Is it? Carrying amount as on 31st March 2002. Is it how much? 2 million. Less depreciation as per the cost model. Is it how much? 0.1 million. Is it right? It comes to how much? It comes to 1.9. Answer is what? One is not. Is it 1 point? I'm sending one message to him. He has to attend, otherwise very difficult. Is it right? If you may. Okay, is it clear? Is it clear about this?
Yes, it's clear.
Yes, is it right? Now, slowly we will do. Nothing will, inshallah. Then, fine. What they have made 3 different things. Is it right? So three. First, you go by case. Okay, uh, case by case. First, we have talked about the factory, and then you have to talk about the head office. Then you have to talk about the machinery. Is it right? Which of the following assets belonging to chestnut? Oh, fine. Means which of the following assets means we have to read the scenario of all the assets. Okay. First, you read the question. It will make sense. When they say all the assets, all the following assets means you have to read the scenario of all belonging to chestnut to require annual impairment review. Is it right? No. What it says, fine. The following issues related to chestnut's non-current assets are outstanding for the year ended 30. On first we take about factory. Okay, on at January 1st 2007, chestnut factory has a carrying amount of how much? 5 million. Okay, it has a remaining life of how many years? 10 years. Fine. On 31st December, there was a impairment review for the factory. Is that they have an impairment review of the factory, and the recoverable amount is going to be how much? 2.5. Chestnut factory has previously been revalued upwards, and the revaluation surplus has a credit balance of 1 million relating to the factory. Fine, good. Next means they have done the remaining model on 31st December. There is a impairment due. They have done it what? They have done it on 31st December 2007. Is it right? No. Which of the following assets belonging to the annual impairment review? That they have done on their review, they have done impairment review on 31st December. Fine, good, no problem. Chestnut head office cost 12 million January 1st and depreciated over 40-year life. As on 2004, there was on 31st December 2004, there was an impairment review of the head office, and recoverable amount is 9. A more recent valuation and 30 has been estimated that the recoverable amount is going to be how much? Is it right? The head office, is it that they have done impairment review when? See, they are what they are asking us. See very clearly, they are asking us the non-current assets as on 31st December 2007. Fine. This has been already done. Is that this has been done when 31st December 2007 has been done? Is it right? Whereas in the second case, the impairment review has been done when the impairment review has done on what? 2004. Fine. The impairment review has done on 2000. They have not done a recent valuation done. They are not. Is it? They have estimated the recoverable amount. Again, you have to know whether they have impairment loss or impairment gain. Fine. Now on that we will need. Okay. We already this has been done. Is it right? This has been done. So there is no point of working on this. Already on 31st December 2000, that is the factory, there is a impairment review. But here it is a 31st December 2004. Is it right? Write down the things. 31st December 2004 impairment review. Fine. Next. Machinery. On 1st to April 2000 just received a grant of 2.6. Is it right? A grant of, okay, we'll talk about grant. You know about how we have done the grant, is it right? When we have received the grant for the current year, we have to identify as a current liability, then subsequently we are talking in terms of non-current liabilities. All this, that process which we have done with respect to the government grants, is it right? With respect to the government grants, we'll do that. Okay. What it says, grant of 2.6 towards new production. The machinery cost to 4 million and is expected to have a 5 years life. Depreciation is charged on a straight line basis. They use the cost model when the accounting for the head office and the deferred income for the relation of the government grants. Fine, see the things. They are asking which of the following assets required. Is it right? Which of the following assets required an annual review? Is it right? Which of the following? This has no annual review. Okay, no annual review done. Okay, no annual review done. Is it? Now, there is no condition that there should be an annual review. Okay, there is no condition. See, when we are doing annual review, when we are talking about the thing, when we are decided that we are going to sell it off. Okay, when we are going to sell it off, when we are going to say that yes, this has to be kept within next 1 year. Is it right? They have not done anything with respect to head office. The head office is a country. There is an impairment review of the head office, and the recoverable amount is 9 million. A more recent revaluation. Is it right? There is no hard and fast rule that every time they have to do revaluation. Is that every time they have to do revaluation? Revaluation is done only with respect to the specific condition when they are meeting it for the IAS impairment, for the impairment. Is it right? This is where it says. Now, the head of, when we are talking about the things, head office, is it right? They have depreciated for 40 years. There was an impairment review. Is it right? And there is no, see, there is one, I will make it very clear here. Is right? There is no hard and fast rule that impairment has to be done annually. Is it? Now, if they is it? Now, what we have done, they have done it for factory. Okay, they have done it for factory. Fine. Okay, that is the need. Here they have not done. Is it right? Impairment has done with respect to what? With respect to head office, they have done it on 2004. Is it right? They have done for 2004. the yes, as simple as that. In that case, here the just I want to make it more specific. 1 minute. Yes. Yes. Is it? Just I will write here. Is it? When there is a impairment, when the carrying amount is greater than recoverable amount. Is it? The carrying amount is greater than recoverable amount. If you take into consideration, go one by one, put by numbers, that will be more specific. Is it? Carrying amount is 5 million. Is it? Carrying amount is 5 million and recoverable amount is how much? 2.5. Is it right? You take the things is what? For factory. Is it right? For factory. Carrying amount is how much? Carrying amount is 5 million. Is it right? Carrying amount is 5 million. Recoverable amount is how much? 2.5 million. Is it? 2.5 million. Here the impairment review is needed. Impairment review is needed. Is it right? Now put the numbers, then only you can understand. Head office. What is the carrying amount? Carrying amount is, how much is that? There was an impairment for head office is 2001, 2007. Amount is that the recoverable amount. See the thing. Here what it says 2004. Is it? Recoverable amount is how much? Recoverable amount is how much? Recoverable amount is 11 million. Is it right? Recoverable amount is 11 million. Fine. Carrying amount is, if you take 9 million also, if you take 9 million and 9 million minus whatever it may be, the depreciation factors, the carrying amount is 9 million, recoverable amount is more. It is impairment review not needed. Is it right? Whereas machinery, what is the received a grant? Is it right? They have the machinery depreciation is charged on. We don't need, is it right? For machinery, I don't think so. We need any right now. We need any impairment. Is it right? Means what? The impairment is not needed for head office. The impairment review is not needed for the machinery. Are you clear about this? First, you have to make sure that what is the condition of the impairment. If the carrying amount is greater than the recoverable amount, then only the impairment is needed. In the factory case, the carrying amount is more than the recoverable amount. That is the reason we have to take. Neither the head office nor the machinery need any impairment review. Are you clear about this? Is it okay?
Can you repeat again, head office?
Head office. Yes. Head office. How much is the head office? See, head office is, what is the recoverable amount? Recoverable amount is 11 million. Is it right? Recoverable amount is 11 million. Fine. As 1 minute, I will write here. Okay. Is it right? Head office. Head office. What is the, how much is the amount? You take it for, you take it as on 1/1/2001. Is it right? 1/1/2001 is how much? 12 million. Fine. 12 million. How many years it is for? 40 years. Is it right? It is for 40 years. Is it right? It is for 40 years. If you take on 2007 also, is it right? If you take on 2000 depreciated over 40-year life, there was a 2004 they have made an impairment. Is it? There was an impairment review of the head office, and recoverable amount is how much? 2007. Is it right? 2000 on a straight line method. If you take into, I'm just writing depreciation. Okay, depreciation. If you take 12 divided by 40, is it right? Into how many years? 4 years. Is it? 12 divided by 40, 12 divided by 40 into how many years? Into 4 years. How much you will get? 1.2. Is it right? How much you will get? 1.2 for 4 years. Is it right? How much is the balance amount? The balance amount will be 10.8. Fine. The balance amount is 10.8. Exactly. This is when it happens. It happens on 31st December. Is it right? It happens on 31st December 2004. Is it right? It happens on 31st December 2004. Definitely on that day the carrying amount is more, the recoverable amount is less. Okay, when it is on 31st December. Is it right? 31st December 2004, impairment is needed because this is the carrying amount. Is it right? This is the carrying amount. This is the carrying amount, and recoverable amount is how much? Recoverable amount is 9. Okay, there is a impairment loss. Okay, there is a impairment loss. But what we are doing, we are talking, now we are talking about what is that? See the thing, I will write here. It is on 31st March, December 2004. Is it right? How much is the carrying amount? Carrying amount is 10.8 million. Recoverable amount is what? Recoverable amount is 9 million. Fine. Definitely impairment condition is satisfied. Is that? Impairment condition is satisfied. Now we are going beyond that. Okay, now what happening is that 9 million. Fine. Here impairment review. Now on 31st December 2007, is it right? Recoverable amount is how much? Recoverable amount is how much? 11 million. Is that? Here what's happening? The recoverable amount is more by default. Is it right? By default the carrying amount, because 11 million is more than 10.8, 11 million is more than 9. Okay, the recoverable amount is more than the carrying amount. If the recoverable amount is more than carrying amount, definitely impairment review is not needed. They want to test us. Only the reason is whether the impairment is needed or not needed. They want to test our knowledge whether we have assessing all three situations with respect to impairment condition. Is it okay?
Yes, it's okay.
Is it clear now?
Yes, it's clear, sir.
Yes. Is it? Now you see the thing. You should know how, only the thing is whether the condition, the only, see, you have to precisely check with numbers, okay, precisely check with numbers, that yes, unless until you don't put the numbers, it is really difficult for me, for anyone. Is it right? Now, better you if you have any small doubt now, you ask me immediately. It will make things more easy. Fine. I will put like this, okay? I will put, because I need more space for do the workings. Is it right? This is for what? This is for 237. In accordance with IS 36, impairment asset, what is the correct journal entry to reflect the depreciation of the depreciation and the impairment of Chestnut factory for the year ended 31st December? They are only talking about the factory, okay? Is it? They are only talking about the factory. Focus on factory only. Okay, focus on factory only. What is the carrying amount? 5 million. For how many years? It is for 10 years. Is it right? It is for 10 years. 30 on 1st January, the carrying amount is 5 million. Remaining useful life is that. On 31st December, there was an impairment review. Recoverable amount is 2.5. Fine. Only for, we are doing it only for what? Just remember, that's very important. They are having 3 different questions. Is it right? One for factory. Where is that? Yeah. Is it right? No. How much is the as on 31st? Is it right? Factory is yes. As on 1/1/2007. Is it right? How much is the carrying amount? Carrying amount is 5 million. Okay. Carrying amount is 5 million. Next. Depreciation for 2007, 5 million divided by how many years remaining? 10. Is it right? How many years remaining? 10. It comes to how much? 0.5. Is it right? It comes to how much? 0.5. How much is remaining? 4.5 million. Is that how much is there? 4.5. Now, this is the carrying amount 31st December 2007. Is it right? 31st December 2007. Okay. Now, what is the recoverable amount? Recoverable amount is how much? Recoverable amount is how much? How much is the recoverable amount? Recoverable amount is 2.5. Okay. Recoverable amount is 2.5 million. How much is 2 million is loss? Is it right? This is impairment loss. Is it right? Impairment loss. Fine. How much is the 2 million? Fine. Next, what they are asking us, what amount should be debited yes, what amount in accordance to 36, how much should be the profit and loss account and how much should be the revaluation account. Okay, now is it right? How much we have, see how much we have, see, is it, keep this one, how much we have to say in profit and loss account, is it right? Total loss is how much? 2 million, is it right? Total loss is 2 million and total loss is 2 million. See the things, what they have mentioned, they have mentioned that there is a credit balance, is it right? There is a credit balance with respect to the revaluation, means they have credit balance, is it right? How much is the credit balance? 1 million. Fine, they have the credit balance of 1. What is the rule we have discussed? If any loss is there, that loss has to be debited against the revaluation only. We should not take other accounts into consideration. Okay, we should not touch any other accounts, only against revaluation. Now, how much is the 1 million? Okay, how much is the 1 million? 1 million is the 1 million is the revaluation of credit. It was a credit gain, now it is a loss, we have to debit it, is it right? But how much we have to debit during the year, is it right? They said that how much we have to debit during the year 2007, is it right? 2 million is the loss, is it right? 2 million is the loss. Profit and loss account, depreciation, is that profit and loss account depreciation. How much is the depreciation we have calculated? 0.5. Is it right? How much is the depreciation we have calculated? 0.5. Next, how much is this? How much is the impairment loss? 2 million. Is that this has to be divided? Is that this has to be divided? This has to be divided. How much is the revaluation? How much is the revaluation gain was there? Credit balance. Credit balance is 1. Is it right? Is it? This is the credit balance. Is it right? Credit balance. Now it will become debit. And what is the loss? There will be 1 million loss. Is it right? There will be 1 million loss. Is it right? This is going to be for what? This is going to be for income, profit and loss account. Is it right? This is for what? This is for profit and loss account. Means profit and loss account, how much we have to make? Profit and we have to get how much? Make it sure, 2 million. Is it right? Plus whatever the value of the asset. Profit and loss account is 2 million. This is depreciation. Is it right? Next, profit and loss account debit. Is it right? This is what? This is revaluation loss. Is it right? This is revaluation loss. Is that how much? 1 million. Is it right? Next, revaluation gain, we are reversing it. Is it right? Reversal. Reversal of revaluation gain. Is it right? Reversal of revaluation. How much we are reversing? 1 million. Is it right? Why we are doing this? That's very, very specific. You should know. Is it right? This credit, is it right? This credit will be done with respect to what? Done with respect to debit. Is it right? This is debit. Is it right? This is debit. Fine. See, again I will explain you. Debit is 0 point depreciation. We have calculated, definitely depreciation will be an expense. Okay. There is a revaluation gain was there 1 million. When there is a revaluation loss, that credit should be debited. Fine, 1 million. Okay, that's why. Total, how much is the loss? 2 million is loss. Is that? This is what? This is the loss of how much? Don't get confused. Is it right? This is the 2 million loss. Fine. This is the loss of 2 million. Is it right? This is 2 million loss. Now that we have accounted. Is that this 2 million impairment loss? We have divided the impairment loss against the impairment gain of 1 million, and the balance amount we have treated as a impairment loss. Now, what is the non-current assets? Is it right? Definitely, it is impacting what? Non-current assets value will decrease. Is that what is the non-current assets? How much it will decrease? It will decrease by 2.5, 1 million and 1 million. Means how much? The non-current assets will decrease by how much? 2.5. Non-current assets will be credited. Are you clear about this? Tell me, any doubt? Think over it, okay? Slowly think over it. See, again I will explain you. Carrying amount is how much? 5 million, first of January. Do you have to calculate depreciation? 5 for the remaining life. 5 million divided by 10. 0.5. Definitely depreciation will be a debit, is it right? Debit profit and loss account. Credit, what we are doing? Credit will be the non-current assets. Is it right? Credit will be the non-current assets. Okay. Now, how much is the carrying amount after depreciation? To 4.5 million. Recoverable amount is how much? Recoverable amount is 2.5. Carrying amount is more. Recoverable amount is less. It is a impairment loss. Fine. When it is a impairment loss, 2 million is the impairment loss. Fine. 2 million, how you have to divide this 2 million? They have said that already we have a credit balance. Is it right? Already we have a credit balance of 1 million. Okay. That 1 million we have to offset. Okay. We have to cancel against that one. First we have to take that with that advantage. Okay. First we will credit the credit balance, we make it a debit. Is it a revaluation? 2 million. There is another balance of 1 million is the loss. This loss we don't have any other option. Is that when you don't have any option, we have to deduct it from the profit and loss account as a revaluation loss. Is it right? So profit depreciation is for 0.5. Impairment loss with respect to revaluation is 1 million. Profit and loss is 1 million. Is it right? How much is there? 2.5. This 2.5 will be credited against what? Against the non-current assets. Is it okay? Take your time, okay? If you find anything difficulty, let me know. Where are you, Ati Bhaiya? Where are you, Rizwan Bhaiya? I am waiting for you. Rizwan Bhaiya, next this till examination. Okay, fine. I have not seen you. Your message will come, then I will wake up, okay? Otherwise, I am I am in this part of the world, okay? Fine. The moment you join, say salam, nothing will happen. Okay? The moment you be a part of the class, I will get energy, as simple as that. Okay? Fine. Can I go to the next one? Fine. Now, what is the, they say that see, what is that, yes, 238, okay. What is the carrying amount of the head office? Okay. What is the carrying amount of the head office? Previously we have done for the factory. We have done, see, they are asking all the three questions. Is it right? They have done for the factory. They have done asking for the head office. They will ask another question for the grants. Is it the revision? Okay. Very simple. Next, till examination, you have to just follow me. Okay. You don't let me go. Inshallah khair. Okay. What is the head office? Head office says that, is it right? Chestnut head office, is it at cost 2.12 million? Is it right? 12 million. And for first, depreciated 40 years. 4 years have been over. Is it right? They have done impairment review. How much is the recoverable amount? 9 million. Fine. How much is the recoverable amount? 9 million. A more recent revaluation after 3 years. Is it right? The recoverable amount is how much? 11 million. Fine. Okay. We will write these values. Okay. 1 minute. And just. Is it? 1/1/2004. How much is there? I have to go 1/1/2004. Sorry, 1/1/2001. 12 million. Is it right? 1/1/2001. 1/1/2001. It is how much? 12 million. Fine. Next. Depreciation is how much? They have 40 years. Is it right? They have done how much? Is it? They have done this for how much? It is for 40 years. On 1/1/2004. Is it right? 1, 2, 3, 4 or 5. On 31st December. Okay. On 31st December. 31st December 2004. Is it right? How much they have done? 31st December there was an impairment and recoverable amount is how much? The recoverable amount is how much? 9 million. Is it right? This is the recoverable amount. Is it right? On 31st December 2007. Is it right? On 31st December 2007. The recoverable amount is how much? 11 million. Okay. The recoverable amount is how much? 11 million. Means, okay, means, see the things. Now, exactly, you will have a complete revision. It's very interesting, is it right? Here what happens? There is a impairment loss. Is it right? By this we can understand. Here there is a hard impairment. Here what's happening from here to here? It is a impairment gain. Okay. Okay, it is how much? Impairment gain. They are asking us about what is the value as on 31st December 2007. Is it right? No. Fine. I will use the space, okay? I will use a lot of space. Is it right? Now. Fine. First we will take the step 1. Step 1, what we'll do, we'll calculate as on, is it right? As on 31st December 2004, okay? As on 31st December 2004. Now, carrying amount is how much? As on 31st December 1/1/2001, is it right? How much it is? 12 million. Is it right? Less this depreciation for how many years? For 4 years till 31st December 2004. Is it right? 12 divided by 40 times 4. How much you'll get? 12 divided by 40 times 4. How much you'll get? 1.2. Good. Is it right? 1.2. How much is there if we take it into consideration? How much? Yes, 1.2. 12 minus 1.2, it comes to 10.8 million. Fine. See, if you, that is the reason you have to revise the lectures before coming to the class. The moment I am touching section A, B, and C. Okay. Now this is the carrying amount. The more you do practice, it is easy, my dear. Don't worry about that. This is carrying amount on December 2004. Okay. What is the recoverable amount? Recoverable amount is how much? Recoverable amount is 9 million. Fine. Recoverable amount. Carrying amount is more. Is it right? Carrying amount is more actually. Is it right? You have to go do it in a reversal way. Okay. Is it right? Is it right? You have to take this here. Is it right? You have to take this here 9 million first. Then you have to take this here 10.8. Is it right? How much is that? It is, how much is the difference? It is 1.8 million. Is it right? You have to do like this. No, just understand. Is it right? The impairment loss. Impairment loss is how much? It is 1.8 million. Fine. Now, this is what? Step 1. Now, the second one is what? It is step 2. They have said that there is a revaluation is how much? 11 million. Fine. They have said that the evaluation is how much? Where is that? Just I'm going back. Okay, I'm going that one. Okay, a recent evaluation is, it is going to be 11 million. Fine. Good. Now, okay, whenever there is a revaluation, is it right? See the things. Whenever there is a revaluation, is it right? Revaluation. Which model we have to use? We have to use cost model or revaluation model? Is it impairment is taking place? Impairment is taking place. Impairment loss is there. Impairment loss is there for the next step. How much is there? Revaluation. Is it right? See the thing. Revaluation is how they are taking revaluation. Is it right? How much is happening from first of 2001 till 31st December 2007? How many years? 7 years. Is it right? Head office, it is the head office, they have mentioned very clearly. Somewhere we have done. Is it right? Somewhere it has been done. Yes. Is it right? Again, the value has been increased. Is it right? What is the rule of IAS 36? The carrying amount, whenever there is a impairment reversal, is it right? And we are talking about the impairment loss, is it right? It has to be recognized for the previous years also, is it right? It has to, whenever there is a reversal, we have to start for the previous years also. Means when we are talking about the previous year, see, this is what it happens, is that put one line here. This is as per December 31st, 2004. Is it right? This is as per December. This is for 4 years. Is it right? This is for 3 years. But when we are going to make it a cost model, we have to do it for what? We have to do it for completely for all 7 years. Is it right? We are doing for completely all 7 years. That's what it says. If there is, it is exceeding the carrying amount. Fine. If it is exceeding the that is the rule. If the amount exceeds the carrying amount, is it right? The carrying amount is how much? The carrying amount is only as of the 31st December. The carrying amount is 10.8 million. Now it is the revaluation amount is how much? 11 million. Fine. Then what is the amount we have to show it with respect to the asset as such? Means when you are doing the things, it's happening like this. We have to follow what? We have to follow which of models are there? Carrying model is there. Revaluation model is there, fair value model is there. Is that when the condition states like this, we have to calculate, we have to use which model? We have to use cost model. In one of the questions we have done this. Is it right? Now when we have using the cost model, is it right? The value as on 1/1/2001. How much is there? It is how much? It is 12 million. Is it right? It is how much? It is 12 million. Less cost model. Is it right? Depreciation for how many years? For 7 years. Is it right? I am writing this from 1/1/2001 till see listen. This is very structured one. If there is a change after some time, is that we have done in the lecture also. When there is a change of the value in the first time we will get loss, then we will get gain. In the second case, whenever you are the value carrying amount is less and the revaluation amount is more, we have to take from the beginning and we have to calculate the depreciation so that we can arrive at the figure as on the date of preparation. Is it as on the date of preparation? What we have to do? 31st December 2007. How much is the 12 million divided by how many years? 40 years into 7 years. We will get for 1 year, multiply it for 7 years. How much we will get? Check again. Check again. How much? Oh. 2.1 million. How much is the value? Difference? See the things, what they are asking. They are asking us very clearly. They are asking us the carrying amount. Is it right? They are asking us the carrying amount. What is the rule of carrying amount? Carrying amount rule is the cost of the asset minus depreciation. Is it right? The formula for carrying amount is the cost of the asset minus depreciation. If you take that into consideration, this is going to be the carrying amount as on 31st December 2007. Is it okay about this? Think over it, okay? After every question, I will give 2 minutes time for you. Is it? After every question, I will give some 1 minute, 2 minutes time for you to just evaluate. Is it okay? Any doubt, just let me know. Don't worry about that. Is it clear? Can I go to the next one?
Yes, it's clear.
Is it right? Yes. I'm waiting for you. Is it? No. Is it? Fine. Practice it, okay? See, once you have class is over, is it right? Relax, take the break, and once it's done, just go through it. Write down on pen and paper, then only it will be easy for us. Is it right? Now, what they are saying, this is where we are talking in terms of government grants. Okay, which of the following statements related to government grants is correct? Is it 1 minute? If it is possible, I will go to that lecture. Okay, I will go to that lecture to make sure that you can have what is what we have learned in government grants. Is it right? What we have learned in government, this is exercise, so this is yes. Here only we have borrowing cost, where investment property. I think here only investment property, government grants, borrowing cost. Is it right? Yes. Yes, borrowing cost. You have the capital grant and government. Is it right? Just I am making it a part of that revision. Okay. You can have that how revenue grants and government grants. Is it right? Yes. What it says, government provides, is right? Government often provides money for this. There are revenue grants and the capital grants. Okay. What is that? This is what grants should be matched with the expenditure. Is it right? Grants will be matched with the expenditure as such. Is that? Is that? Grants will be matched with the expenditure towards which they have intended to contribute. Most importantly, is that what is the question they are asking? Is it right? What is the question they are asking? Which of the following statements related to government grants are correct? Okay, the deferred income method should always be used for government grants. Is it? Government means deferred income means always. Is it right? Means when they have received. Grants related to income must be disclosed separately in the statement of profit and loss account. The deferred income method should only be used if the grant is repayable. Grants related to assets can be accounted for using either deferred income method or by deducting from the assets carrying amount. Is it right? See what happens. The most important thing is whenever you are talking about the grant, again we will go back to that slide. Okay, whenever you are doing the things, there are two things that happens. It will have it will have impact on income statement. It will have impact on current liabilities. It will have impact on non-current liabilities, and it will have impact on non-current assets. Is it right? That happens whenever there is a government grants. Fine. Now we will go to that lecture as such. Is it right? We will just revise it. That government grants are similar to the things. Fine. Government grants is designed locally. Fine. Government grants are assistance in the form of resources. Grants to income are rather than related to assets. Fine. What is the, if the grant is paid, there is a certain expenditure has been done, should be matched with the expenditure. Okay, this is one of the conditions. Is it right? This is one of the conditions as such. If the grant is paid on deferred basis, it has financial objective. It has to be matched with identifiable cost of that objective. This is another condition as such. Is it right? This is with respect to what? Government grants. So next, it has to be credited in statement of profit and loss account and deducted from the related expenses. This is related to which type of grant? Revenue grant. Now, coming to the how you have to make presentation. Is it right? It has to be inappropriate. The claim that supporters of this method say that you should not deduct, it is inappropriate to net income and expenses. Separation of the grant from the expenses facilitate comparison with other expenses. There are some arguments and disarguments. Okay, deduction, if it is argued that with this method the expenses might well have not incurred for the entity. Yeah, if you are not spending, you should not take into account. Is it right? That is with respect to a revenue grant. What is the capital grant? Write off against either. This is what it says. Is it right? Write off grant against the cost of non-current assets and depreciate the reduced cost. Depreciate the reduced cost is nothing but it will talk about the profit and loss account. One side we are talking in terms of statement of financial position. One side we are talking in terms of profit and loss. Treat the grant as deferred credit and transfer a portion of each year. So offsetting higher depreciation charge. What treat the grant as a deferred credit means when deferred credit means as year on year basis. Is that when they say it is a deferred credit, it will be on what? It will be on year basis. Is that these two conditions have, these are the treatments. Is it? These are the things which we have to make the treatments. Now based on this we have to solve that question as such. Is it right? Based on this. Now what they say, what is the following? Okay. Is that? See that the deferred income method should always, see, there is no hard and fast rule that you have to use always. Is it right? Whenever, see, to my knowledge, I can say with that much specific thing that we should not, whenever there is a use of always, see, there is no rigidity in accounting. Accounting talks about flexibility. Assumptions are there. You will never give you one option. Okay, this is the technique. This is the last option we have to use when you are analyzing. Have any doubt in MCQ? When you have any doubt in MCQ, definitely you will have 20 questions. You will have 5 questions. You will have some doubt. Then you use some techniques. Okay, there is no rule that you should have always. Is it right? Deferred income treatment should always used for grants related to assets. Fine. Is it? They should miss what happens. Sometimes what will happen, it will be for the revenue grants, it will be for the capital grants. Revenue grants treatment is different, capital grants treatment is different. Grants to income must be disclosed separately in the profit and loss account. We are talking only about profit and loss account. Where is statement of financial position? Is it right? We have to think about that also. It's not only one case. Is it right? Is it? It's not only one case. The deferred income method should only be used if the grant is repayable. Is it? If it is not repayable, in other case also what happens? We will use the grant subject to current year, and for the next year, see, the rule is same, is that you are getting 1 million, okay, for 2 years. When you are getting 1 million for 2 years, we use 500,000 for this year and 500,000 for the next year. Is it? If the grant is repayable or it's not repayable, usually grant is not repayable. If it is not used, then only we will repay. Understand my point? If you are not using, then only we will repay. Otherwise, there is no question of repayment as such. Is it? The grant related to assets can be accounted using either. You have the option, isn't it? Either deferred income method or deducting it from the carrying of the assets amount. Is that? Whether you can deduct it, you have the option. Is that? See, always accounting gives you option. Methods, assumptions, these are the one. We never come across. They say that you have the option, either you can use it as a deferred income, or if that is not the case, whatever the carrying, both are same. Literally, if you ask me, both will have debits and credits at the appropriate level as such. Okay, so whenever you have the grants, you have the option, either you can use it as a deferred income, or every year subject to the usage you deduct it from your carrying amount of the assets. First here, the same treatment. There is no second thought on this. Okay. What is the carrying amount of the grant? Is it right? What is the carrying amount of the grant in Chestnut statement of financial position as on 31st December 2007? How much they have received the grant? Is it right? How much they have received the grant? This is where we use with respect to what? This is we use the deferred. Whatever the condition has been said, is it right? Whatever the condition has been said, we are following the condition as per 239. Is it right? As per 239. Is it right? This is the condition and this is the rule. Is it right? This is the rule and this is the application. Fine. How much they have received grant? They received grant is how much? They received grant on 1st April 2007 is how much? 2.6 million. Is it right? 2.6 million. Just go back. How much they have received? 2.6 million. And the machinery cost is 4 million. Useful life is 4 years. Depreciation straight line method. They are using the cost model. Which has and the deferred income method. They mention very clearly. Is it right? They mention what? And they are using the deferred income method in relation to the uses cost model. Is it right? So you are using cost model and deferred income method. Fine. Now, deferred income method means you have to deduct for the thing. Now, when they have see the thing, they have received it on 1st April 2007. Is it right? 1st April 2007. And see the thing. Is it right? This is it. They received it on when? They received it on 1st April. Now they are asking for what? They are asking for 31st December to 31st. Is it right? Recognized. Is it right? Recognized. Till 31st December. Is it right? 31st December. How many months? 9 months. Is it right? 9 months. Is it right? Now, how much is there? 2.6 times 9 by 12 times 1 by 5. It should has to be like this. I have done in different way. Is it right? It has to be like this. 2.6 into 1.5. You can put like this also. 1 minute. Is it 2.6 million divided by 5 years into 9 by 12. How much you'll get? $0.39. Difference is how much? Difference is 0, 1, 2, 2. Okay, 2.21. Okay, 2.21. Fine. This is when you say it is the balance. Is it right? Balance as on 31st December 2007. Okay. Next. Now, how much is the every year? How much we are having? Is it right? Every year, how much you are having? Every year, current liabilities is right. 2.6 divided by 5. It comes to how much? 2.6 divided by 5. It comes to how much? How much fast? Rizwan Sheikh. Yes, Shifa. 0.52. 0.52. This is every year. Every year we have to treat it as a current liability. Is that every year we have to treat it as a current liability? Is that what is the carrying amount of non-current liability? It is this is a for that means next year whatever you are paying. Next year whatever means whatever you are paying in 2008, it is a current liability. Is it right? This is the current liability. Now less current liability for the year 2008. Is it right? Current liability for the year 2008. How much it comes to? It comes to 0.52. Is it right? It comes to how much? 0.52. If you take that out, if we take 0. How much? Sorry, 0. It comes to how much? 1.69. 2.21. 2.21 minus 0.52. Fine. Is it right? This is the amount. This is the amount to be shown as non-current liability on 30th December 2007. Is it okay? Take your time, okay? That's very take your time, understand. See, I'm writing with I'm just putting each and every calculation as best as possible. Okay, even you have a smallest of the smallest doubt, is right? You can have if still you can process it in more simplest of the simplest way, but alhamdulillah it's doing well. Fine? Okay. We'll complete this, okay? Is it okay? Can we do this? It will take another half an hour. You have patience, I will do. Don't say no. Okay. Fine, done. That's the reason I know.